Hello, this is David Bionic Turtle, continuing review of CFA Level 1. Broadly, we're in financial statement analysis and in particular ratio analysis. And there are several categories of ratios, including activity ratios, which are also known as efficiency ratios, large bucket of those. Here we'll just drill down into the popular activity ratios for working capital and see how they combine into the cash conversion cycle. Starting with inventory turnover, it gets at the question, how many times was inventory turned over or sold during the period? Typically a year, could be a quarter. So we have inventory turnover here, which is a ratio, and right away something interesting about it, it's a ratio of an income statement account, that's cost of goods sold, so that's a flow over a period, say over a year, divided by a balance sheet or stock account. And so we could use a year-end inventory, but it's generally more appropriate because this income flow is over the whole year. It's generally more appropriate to use the average of the beginning and year-end inventory. So those are balance sheet or current asset accounts. So that inventory turnover is then divided into 365 days per year. Could use 360 there to get what the CFA refers to as days of inventory on hand, DOH, duh. I think it's also just as common, maybe more common, you will see days inventory outstanding means the same thing here. And so since we've got the two ratios, you might be able to figure out that we could reduce this to a more elegant formula for the days of inventory on hand, average inventory divided by cost of goods sold, that would be pronounced COGS, multiplied by the 365. Same exact result. So for example, if for the company, the cost of goods sold, again, an income statement account over the year was $600,000, and the average of the beginning and year-end inventory, a current asset account, was say $25,000, then our inventory turnover would be 24. Inventory was turned over 24 times during the period. Divide that into, or 365 divided by that same 24 then gives us here 15.2, and we could say the company kept about 15 days worth of inventory on hand. Now, all of these ratios, like most ratios, it's impossible to just evaluate them in isolation. Generally need to evaluate in context and perhaps according to their own history. So a higher inventory turnover would correspond to a lower days of inventory on hand, and oftentimes that would be a strong sign indicating better inventory management by the company, especially if sales were strong. But on the other hand, it's always an equivocation there. If sales were weak, high inventory could mean that the company is constraining or contributing to its own low revenue growth through inventory shortages. So you see how it could go either way. In terms of receivables, we have days of sales outstanding, DSO, and similarly, see how we have ratios here in parallel. Receivables turnover is going to be generally revenue, credit sales if we can get it, divided by average receivables. And again, we have an income statement account divided by the average of the beginning and year end of a current asset or balance sheet account. And then the DSO, days of sales outstanding, we take that receivables turnover, divided into 365. And again, we can find a little more elegant expression here of the DSO, average receivables divided by revenue times 365. And so if we took an example here, a company with revenue for the year of 2.5 million, receivables at the beginning of 2011 of 150,000, growing to 250,000, such that the average receivable during the year, simple average of those two is 200,000. Then our receivable turnover is going to be the 2.5 million in revenue divided by the average receivable of 200,000 gets us 12.5. 365 divided by that 12.5, and we get about 29 days. And then we can say for the DSO, on average, it took the company about 29 days to collect its receivables. Now, there's also a little bit of equivocation here, but in generally, we like to see a lower number, a lower DSO, that is. A lower DSO means that company is collecting its cash faster, so it's more efficient with its credit and collection policy. On the other hand, hopefully it's not so efficient that it's actually employing stringent credit policies. High DSO could be a red flag. Finally, payables turnover and number of days payable. Similarly, payables turnover, purchases divided by average trade payables. Then we take that payables turnover, divide it into 365, can find the equivalent elegant expression here, DPO, days payable outstanding. And for example, if the purchases during the year were 1.5 million with an average trade payable, again, that's the average of a balance sheet account, this time a current liability. If that were 100,000, we would have 15. We could divide that into 365, and then we get, in this case, 24 days, and we can say, on average, it takes this company 24 days to pay its payables. Recall with DSO, or days sales outstanding, we on average prefer to see a low number with DSO, meaning the company's collecting its receivables quickly. DPO is the exact opposite. In a low DPO is generally something we don't want to see, because that generally would indicate that the company's not taking advantage of the credit facilities that would be available to it. And finally, we can pull those three activity ratios together into the cash conversion cycle. And if we think about here on the left, the company spends cash to create inventory. And right here, in a sense, that cash is trapped as inventory. One asset becomes another, a liquid asset into a less liquid asset. And then once the products are sold, those products in inventory is sold to customers, an invoice would be issued, and then it becomes a receivable. But that's not cash yet either. So these two processes here, in a sense, they are uses of working capital. They consume cash. And all other things being equal, the company doesn't look forward to longer periods here. On the other hand, days payable is cash payments to vendor and works exactly the opposite direction. So we can take inventory days inventory outstanding plus days sales outstanding and subtract days payable outstanding to get the cash conversion cycle. In the example we just looked at, we had days inventory on hand. It's a synonym of 15.2 days. We add days sales outstanding of 29.2 days. These are uses of working capital. And then offset that, subtract a source of working capital, days payable outstanding of 24.3 days. And that gap is what is left and equals the cash conversion cycle of 20.1 days. In a sense, the time from start to finish that this cash is trapped on a net basis in the working capital cycle. This is David of Bionic Turtle. Thanks for your time.